So outside of these, if you want to see me, you have to email me, okay, first. Just a couple of things. In lectures and labs, if you can keep your phones on silent. And on questions, I would like people to ask as many questions as possible, because usually if you have a question, it means that something hasn't been covered well enough, or you're having difficulty with a particular topic. And it's better if I spend more time on that. Okay? So if you've got the question, other people probably have the question, and it's more efficient if you ask me in the class, so then I can tell everybody at the same time. Okay? So if you don't get something or you don't understand something, just ask me in the class, okay, and I'll spend more time on it. Okay, so yeah, it looks like, could everybody just shove up a seat to the left if you've got a space on your left so people can sit down there? Yeah, in general, if you could just fill up from this side of the room, because it's quite tight in terms of the number of seats. And also, if you could come before the start of the lecture as well, that would help. Okay, so if you ask questions during the lectures and not after, don't be shy. Sometimes people are afraid to ask questions. I prefer, it gets very, very boring if I stand up here and I'm just talking all the time, and nobody is, nobody asking anything. Says, I don't know how you're getting on. So feel free to interrupt me and ask me questions. So also, email-wise, you can email me and ask me questions, but before you email me, I would ask that you check either with a classmate or in the textbook, or using the internet. Okay. So this is the textbook for the course. It's a very good book. The guy who wrote the book has been teaching this topic for decades, and in the book he includes examples and data sets using eViews, which is the software that we use on this course. So it makes it very easy for students. Okay, there's examples in there. There's eViews examples in every chapter that you can try out yourselves, and all of the theory is in there related to the course. It's all in one book. And if you go onto the module description for the module, you'll find that there's a large section of the hours on the course are actually reading. Okay, so you're supposed to read, and I recommend that you read the chapters in the book. We're basically following chapters from the book, of course, so I recommend that you read them, because they're more in depth than you can possibly cover in a lecture. Okay, so the course software is eViews. I mentioned that already. We're going to have labs that go in parallel to the lectures. So when I teach a lecture, then there's a lab following that covers the material in the lecture. So you get to try things out yourselves. Ultimately, you should be able to use eViews at the end of this. You should be very comfortable with it. And if you're doing a thesis and you're using eViews at the end, you'll find that it's a great help. Okay? So you'll be able to use it. And you'll be able to do the examples from this book. And actually, very similar examples would make very good thesis topics. Okay? So you might get some ideas for thesis topics. There's some parts of the course that you like. Okay, so that's general information. On the assessment, so what's nice about this course is that 50% of it is based on the coursework, okay? And 50% is on a written exam. Last year, a lot of people did a very good job on the coursework. The advantage in the course is that the labs follow the lectures, and I give examples in the labs that cover the section of the coursework that you have to do individually. Okay, so there's no excuse for not getting it right, and if you're organized, you can do the coursework as the course goes along, which is what I recommend. So when we're in a lab, I give you examples and I'll teach you how to do something. You and your groups then should work on the same thing, but related to your own project. Okay, so you all have to pick different data sets, and you're all going to work on different data sets, the ones that I use in the examples. But what you run on those data sets will be the same thing that I run. Okay, so you'll have to successfully run them on your own data. Okay, so you can do that as you go along. And that's what I recommend. So then you're not in a rush at the end, you're not trying to find people who are off on holidays and you can't make contact with them. You know, try and be organised and do it as you go along, and then it's very painless. You've got half your coursework done, and you've got 50% of an exam. And the exam is also based on the coursework, a lot of it. So there's some extra theory in the exam, but if you do a good job in the coursework, you'll actually be able to answer a lot of the exam questions as well. So it's worth putting the work in, turning up to the labs, and trying to do them. Okay? The other thing, an issue that was clear last year was that because there was teams in the project, some people in the team hadn't done anything. Some people in the team had done one section, and they said, oh, there's 4 of us in a group, so we're going to split it into 4. I'm doing the first bit, somebody else is doing the second bit. You all have to do every bit, okay? So it's like a chain is as strong as its weakest link. Everybody has to do each bit, okay? And even if somebody else does more work on a section, you have to review it and say, I don't think that's right. Because if it's wrong, you're going to lose marks. You're all responsible for the whole project, okay? So you're going to do as well as the worst member, or you're going to do as well as the best member. It's your choice. If it was me, I would try and do as well as the best member of your group, okay? So it was clear last year as well in the exam that people just hadn't done anything. Because one of the questions was directly taken from the coursework, and a lot of people couldn't answer it. But yet they were supposed to have done it in the coursework. Okay, so I'm warning you now. Make sure you all do everything in the coursework, and you don't just split it up. The other thing is the teams will be teams of 5. Some teams will have 4. It's not an advantage or a disadvantage to have 5 versus 4 because everybody has to do everything, okay, in the group. You know, you might have 5 people, you might have 4 people. Any questions on that so far? Anyone have any? It's all clear. Okay, so that's just some of the things from last year that I thought I would say early on, you know, because if you do the coursework and you complete it and you make a good effort at it, you'll do well in the subject. It's as easy as that. Okay, so just an outline of the course. I don't know, some of you are from different backgrounds. There are statistics involved in econometrics. I'll try and cover that as intuitively as possible. So what I would say to you is don't have the mental attitude that I don't do statistics, I don't understand them, and I'm not going to try. You know, everything is understandable that we're going to cover. Okay? It's up to you what level you understand it at or how in depth you get into the mathematics behind the models. There's the freedom there to get into more if you're interested in it, or less if you're less interested in it. Okay? But you should have a basic intuition and an understanding of how they're applied when you run these things in use. And you need to have that to interpret the results that you get. Okay? And interpreting the results is going to be in the coursework and also on the exam. Okay, so today we're going to do an introduction, some foundation concepts, and a very simple regression example. So some of you may know what a regression is, some of you may not. Normally in finance or economics, you're looking for the relationship between 2 different variables. So, you know, a typical one that we're going to look at is if you look at the returns of a particular company's stock. Okay, so Microsoft stock returns. What would affect those? Okay, and often what you look at is, say, a market index. So the S&P 500 or an aggregate market index. If the market as a whole is up on a particular day, individual stocks are more likely to be up. Okay, and the extent to which stocks move with the market depends on the stock. So some are more dependent on the market and some are less dependent on the market. Okay, so you can imagine. You know, consumer discretionary things that people don't have to buy, but they buy, you know, they buy if they've got money or if they've got spare money. Those are the first things that people stop buying if things look bad in the economy. Okay, so companies that sell those type of things, they've got a big exposure to the economy and to the stock market going up or down. Other companies such as pharmaceuticals, whether the market is up or whether the market is down, people have to buy medication. okay, especially if they're sick, they've no choice. So they're less exposed in terms of their sales to whether the market is up or down. So the relationship between a stock returns and the market returns is different by company, and you might want to estimate that. Okay? So that's what we're going to look at with a simple regression example. How one factor or one time series of returns affects another one or predicts another one. Okay? And in finance, it's never simple. You can never say, you know, that a particular stock's returns are going to be 0.9 times the market return. They might be 0.9 times the market return plus some other noise, because there'll be things specific to that company that affect that company more or less than the market gets affected by them. So when you run a regression, you often have a relationship, and then you've some constant value, and then you've got a noise value, which is not explained by the relationship. So we're going to look into that in a bit more detail today. In the second lecture, we're looking at something called the classic linear regression model, which is a way of estimating a regression. So it's a way of answering that question: how much does a stock's return depend on the market return? And then in the third lecture, we're going to look at ARMA models. So a lot of the time in finance, a stock's returns aren't completely independent of its returns yesterday or last month. You know, you might find that if a stock is up today, it's a little bit more likely to be up again tomorrow. Okay, so that's it's called autoregressive. So it means if the value of something today depends a little bit on its value yesterday, or on its value the day before, or on its value a week before, or a month before, a year before, there's some autoregressive component in there, and those are used a lot in finance. In particular with volatility estimation. So when you look at the volatility of financial markets, they're autoregressive. So if there's high volatility today, there's going to be high volatility tomorrow. Not exactly the same level, but you know it's not going to reset overnight. Okay. Okay. So there's autoregressive and moving average models. So we get into those in the third lecture. Then in the fourth lecture, we're going to look at volatility modeling, which is huge now. So volatility modeling, there's a link between volatility and returns in the market. So when there's high volatility, there's normally negative returns. And also, people who buy and sell options are very interested in volatility, because when they quote a price for options today, they're worried about volatility over the lifetime of the option. So, you know, volatility it's an area that there's a huge amount of research in, and there's lots of different types of models. And the software that we use, eViews, just has all of these models already in it. Okay, so you can just run them. You don't have to program them yourself. You can just try them. And then we're going to look at how you measure what's a better model. Okay, so which model describes volatility better? How do you decide that? How do you pick a model? How do you rank models? How do you compare them? We're going to look at that. Then in the fifth lecture, we're going to look at unit root testing and co-integration. I'll cover those in the fifth lecture. And then lecture 6 is going to be a review of everything, okay, and like a revision lecture. So does anyone have any questions on that? If you have a look at this book, you can see where those lectures tie into the book from looking at the table of contents. Okay, so to start off, one of the things that you need to know about is how do you measure certainty? How do you measure uncertainty? If I tell you that Microsoft, the relationship between Microsoft and a stock index is 0.9, the returns on Microsoft are 0.9 times the returns on stock index, you might say to me, how sure are you about that? How confident are you that 0.9 is the right number? Maybe the right number is 0, and you just got 0.9. How did you measure the 0.9? So when you use 0.9, what's your average daily error using that? And obviously, the larger the error is, the less confident you're going to be about your estimate. Okay, and that's something we're going to cover later. So just to get into a little bit of statistics and randomness, I was going to get everybody, if everybody could tell me what country they're from, if I can list countries for the class, I'm going to split you into teams. So China is going to be normally it's quite a big one. Okay. So I can confidently write China down. It's definitely any other countries? Anybody from
India.
India, there's another one, okay. India. Anybody else? Yeah? Malaysia? Malaysia. Anybody else from Greece? Okay. Any others? Colombia? Where was that? Sorry. Colombia. Colombia. Okay, yeah.
Germany.
Germany, yeah. Okay, anybody else?
Lebanon.
Lebanon. Okay. I probably should have done a bigger or a smaller font size. So Lebanon. Okay. Any others? Yeah.
US.
US. Others? Thailand. Thailand.
What about you?
I'm from Ireland. But I'm not going to guess because I know, well, it's random. So any other countries? Anybody else? Vietnam? No? No? Okay, so here's what we're going to do. We're going to flip 12 coins at a time. Okay? And for every head that you get, it counts as 1. Okay? And a tail is 0. So you have to guess how many heads you're going to get in each trial. Okay? How many of the 12? So for each country, I want somebody to give me a number. Okay?
How many are you in the class?
How many are in the class?
Yeah.
Well, it's 1 per country that you're gonna have to pick. So 1 person from every country is gonna have to give me a number. The first person who talks for that country. So you gotta give me a number between 0 and 12, and you're gonna predict how many heads you get when we flip a coin 12 times. And we're gonna run the trial. We're gonna do that 10 times. Okay. And then the person who's right the most, the country that's right the most wins at the end. Okay. So you have to predict how many of 12 coin flips are going to be heads. So if I tell you heads or tails, I flip a coin. Now I'm not going to flip a coin. But I'll do it on the computer. So if I say heads, it's heads. So that's 1 point. Okay. If I do it on its tails, I get 0 points. Okay, it's heads again. So that's 2 heads. If I did that 12 times, what would the score be? 1 for a head, 0 for a tail. So you have to guess how many heads you're going to get in 12 goes. Okay? I'm going to repeat the trial a few times. So does anybody want to start with? I mean, it's an open cry system. So the first person to give me a bid gets their bid in.
6.
So who's going for 6? Okay. That was Colombia. It's going for 6. Yeah. Okay. Who's next? Who wants? China 8. Okay.
Lebanon 7.
Okay. Yeah.
Germany 5.
Who's 5?
Germany.
Germany 5. Okay. Who's next?
India
Yes.
1.
India 1. Okay. 9. Okay. Who else?
US 7.
US 7.
Yeah.
You can't have 7 because
I can't
it's
have
gone.
7.
Yeah.
10?
You can have 10. You want 10? Yeah. 10. Okay.
Thailand 12.
12. Four. Yes. Okay. That doesn't give me much option, does it? Okay, I'll go for 11 then. Which, Okay. So now we're gonna give it a go. And the winner will just get a tick each time. Okay. So. Okay, so here's the website. So, I'm just going to go back in. We want to pick 12 virtual coins and flip the coins. Okay, so the dragon is the head, okay? So you've got 1, 2, 3, 4, there's 5, okay? Woo! So Jeremy got 1. Okay, how many did I say I do? Okay, so 1, 2, 3, 4, 5, 6, 7. We've got 8. Okay, so 8 got 1. Go again. 1, 2, that's 3. Okay, so 3 got 1. Nobody got 3. Okay, so the 7 got 1. So 4 got 1. Okay, so we'll just, the next person who gets 1, we'll call them the winner, okay? The next person who wins. Because I could be at this for a long, long time. That's 3. That's a bad omen. Okay, sorry, everybody fails the year now. That's it. Alright. Okay, 1, 2, 3. Yeah, so 6. So that actually is bang on, okay? So, so Colombia won, okay? So you can see if we continue it a bit longer, over a lot more trials, what would you expect the value to be roughly around? Yeah, exactly, yeah. You're going to get it. You can see that as you keep playing the game, more extreme values are less likely, okay? So getting no heads means you're getting all tails. It's very unlikely that you'll continuously flip a coin 12 times and you won't get any tails, okay? There's only one way you can get no tails, and that's for every single coin to be heads. There's lots of different ways you can get two heads, for example. So the first one could be a head and the last one could be a head, or 2 of the middle ones could be a head. There's lots of different ways that can happen of all the possibilities. So you find that when you get towards the central values, they're more likely. Okay. So you get a distribution. Okay, so this probability here is if we kept running this game and we added up the values and then we divided them by the total number of times we played the game. So if we played it 100 times, and for each of these values between 0 and 12, we looked at the number of times that we got a particular value, okay? And we divided it by the total of 100. What you would find is that 6 is the one that happens the most often. But other values are possible, okay? So this game has an expected value of 6. You'd expect the value to be 6, okay? But if you play at different times, you don't get 6 all the time. There's variation around that. And the variation around that, a measure of the variation, you can imagine that if this was just one spike in the center at 6, and everything was always 6, there's no variation there. You're absolutely confident that the value is 6, okay? The more spread out it is, the less confident you are. And a measure of how spread out it is the standard deviation. Okay? So whenever you hear about standard deviation, it's a measure of how wide this is around the expected value or around the mean value. And the bigger the standard deviation is, the further you can be from the expected value on a particular trial. Okay? So if I told you that Microsoft was 0.9 times the market return on a particular day, and it was always 0.9 times the market value, you would just have a spike. If the market return was along here, you'd have a spike at the market return. Okay? If Microsoft had other random data in there that was moving it away from its expected value, and if the expected value of the random data was 0, so it means it nets out to 0 on average, but on any particular day, the random content could be higher, it could be positive, or it could be negative. What you'll find is you get a spread of values for the Microsoft return, around 0.9 times the market return. Okay, and the bigger the spread is, the more significant the random noise is in the model. Okay, if there was no noise, it would always be 0.9 times the market return. But because there's noise, there's going to be a spread of values when you measure them on any particular day. And some days it might get quite far from 0.9 times the market return, but those days should happen less. Okay? But that depends on how large the noise signal is. You know, if the noise signal is very large, then it could get quite far from 0.9 times the market return. And if the noise signal was very, very large, actually, you wouldn't be sure if Microsoft was affected by the market at all. The value could be zero. So basically, if your mean value here, if this mean value here was very close to zero, and you had this random noise, if the mean value was only 0.5 or something like that, you can see that you're quite likely to get a jump of 1 on any particular day, either above or below. And it will be very hard to distinguish whether the 0.5 that you read was due to noise and the value was actually 0, or whether it was a correct value. Okay. So here, because the mean is 6, you can see that when you add the noise of the coin flips, you're still quite sure that the mean isn't 0. Okay. You've got quite a high level of confidence. Under this distribution, it's very unlikely that you could get a low value. Okay. And that's what we're doing. We're measuring, when we, in econometrics, when we look at a relationship, we're measuring how strong is the relationship, how much confidence do you have in that. And when you look at the noise or the error in your model, if it's very, very big, you can't be very confident in your relationship estimate. There might be no relationship, and what you're seeing is just due to randomness. Okay? So whenever somebody says there's a relationship between, say, you know, a foreign exchange rate and a stock index, they run a regression and they try and find some kind of relationship between the two of them, and they might find some small coefficient or some relationship. But if they report that on its own, their paper won't be taken seriously. They have to give some estimate also of how confident they are about that level. So when you use their model, and there's a change in foreign exchange, and you try to predict the change in the stock market, how accurate is it? And if there's large errors every day, and the relationship that you're claiming is quite small, you can't be sure that, you can't be very confident in the relationship. Right? So we saw how you build up this, and how the mean value is the most likely value. But you can also get other values around that. Okay? If you draw a distribution around these bars, as you increase n, as it gets bigger and bigger, this becomes smoother and smoother. You can imagine if you filled in the gaps here with bars, you get this kind of familiar bell curve, okay, which is the Gaussian distribution or the normal distribution. And how this came about was literally through people flipping coins and betting on them. Okay? And this guy, Demoivre, was a mathematician. And he was interested in gambling. He worked as a consultant to gamblers. And they had more and more complicated games, like flipping, you know, more and more coins and different permutations and combinations of things. And what he thought was, what if I could come up with a formula, instead of having to work out the probability of, say, exactly of getting 7, or the probability of exactly getting 3, and so that I could work out fair odds for that. What if I had a formula that did that for me? And that's how he basically fit a curve to this histogram, and the equation for that curve gives you the Gaussian distribution, or the normal distribution. And the advantage of that was that he could plug in values that he hadn't actually calculated. So he calculated these values, he fit a curve to them, and now all of a sudden he can calculate other values, okay, that he hasn't actually worked out individually going forward. So if some gambler asks him, what's the probability of me getting exactly 7 heads if I flip a coin 30 times, he could just do a calculation and use the formula and give it to them. Okay? charged them because these people were playing games and they were offering people odds and they were making money out of it. Okay, so one of the things we look at is expected value, or the mean. The mean, what's the expected value? So we're going to change things slightly here. And the reason for this is that whenever we deal with noise or random noise in econometrics, we're normally looking at something that has a mean of 0. That's actually a requirement of using statistical inference in some of these models. So we want to look at something that has a mean of 0. So if we get +1 for a head and -1 for a tail, what's the expected value for a single coin flip? Does anybody know? What would be the average value? What's the mean, or what's the expected value for a coin flip? Yeah, I think someone said it's 0, right? It's 0. Can you get 0? No, you can't, because you either get +1 or -1. So, on average, how wrong are you going to be on a particular flip? So if your estimate is the mean or the average value and it's 0, and you get a +1 or a -1 every single time, on average, how wrong are you? What's the deviation from the mean on average? It's 1, right? So if you forecast and you say, I forecast a 0, and the expected value of this is 0, if you forecast a coin flip and it's +1, you're out by 1, and if you forecast it and it's -1, you're out by 1. And the standard deviation is 1, okay? So you're out by 1 on average. The average error in your forecast is 1. So if you look at 6 flips, what's the average value going to be? Okay, so it's going to be, it's still going to be 0, right? And for a single coin flip, I covered that what the expected deviation from the mean is. If your mean is 0, on any particular flip, you're either +1 or -1, you're out by 1, okay? If you've got a +2 or a -2, you'd be out by 2 on average. So for n coin flips, so if you do 10 coin flips, what's the standard deviation? Okay, so if you work it out statistically, it's the probability of getting a head by the probability of getting a tail, and multiplied by the number of coin flips that you do, and you get the square root of that. Okay, so for 10 flips, it would be 10 by a half by a half, if it's a fair coin. And the reason the 2 is here, okay, is because we've rescaled this to have a difference of 2 between +1 and -1. So often if you see this formula, you get a 0 for a tail and a 1 for a head, and in that case you would get rid of the 2 here. We've made the difference between the 2 twice what it was before. The difference was 1, you got 0 and 1, and now I'm going from +1 to -1, so the difference is 2. Okay. The reason I've done that, as I said, is to make the analogy to having a 0 mean. So if you've got 0 for a tail and 1 for a head, actually your expected value would be 0.5. Okay. And your standard deviation would be 0.5, because you'd get a 1 or a 0, and your estimate was 0.5, and you'd be 0.5 out all the time. Okay. So you can see that even though you know the expected value, and if you flipped 1,000,000 coins, you would get very close to 0. Okay. If you've got +1 for a head and -1 for a tail, you get very, very close to 0 as an average value over it. And I'll show you this in Excel or in eViews later. The larger the sample, the closer you get to the mean. So if you flip 1, you're never going to get the mean, okay? Because the mean is 0. You can't get it. But as you increase your sample, if you increase it to 10 million, 10 billion, the mean would zero in on 0. You'd see the error, the difference between 0 will get smaller and smaller the larger the sample. And so statistically, the larger the sample is, the more the mean of the sample will tend to the true mean. And this is where sampling error comes from. The smaller the sample you use, the more error there is, because you could randomly pick. Let's say there was a jar full of coins, and some of them were sterling and some were euro, and it was 50-50, and you had to guess how many were sterling and how many were euro in the whole jar. You could pull 5 out, and you could pull out 5 sterling coins just by chance. Okay. Okay, that's a sampling error. Okay, so you wouldn't get 50-50, you'd say it's 100%, they're all pounds. If you pulled them all out, you'd get exactly 50-50, because you'd have the full sample, you'd know exactly what was there. As you move from a small number to a large number in terms of sampling, you get closer to the true average value. Okay? So there's two things that come into play when you're estimating econometric models. One is how large the noise signal is relative to the information signal. And in finance, the signal to noise is quite weak normally, because financial markets, especially if you're forecasting, they're very efficient. People are correcting prices all the time. It's very hard to come up with a model that predicts stock prices, okay, because everybody's doing it. And as soon as someone predicts a rise in the stock market tomorrow, they're going to buy and the price will go up, okay? Then when you go to buy, the price is already up and you're not going to get the gain from the earlier price and the price tomorrow. So the market corrects all the time. So financial markets are very efficient, especially if they're highly liquid. So the signal to noise is very low normally in financial markets. You know, when you measure a relationship, the noise around that and the forecasting error are normally quite large. So that's the first thing. How big is the noise? How big is the random signal? The second thing is how big is your sample? So if you had a forecasting strategy and you use daily returns and you estimated it over the last 30 days, okay, how confident would you be in it working for the next 30 days? You wouldn't be that confident, right? If you had it and it worked every day for the last 10 years, you'd be much more confident that it's going to work tomorrow, even in the presence of noise. Okay, so even if there's a large amount of noise, if you've got a very long sample, the value will tend towards its mean in the long sample, and it's very unlikely to be really zero if you're seeing something that lasts over a long period. So there's a couple of different considerations when you're asked how confident you are about a model or how confident you are about an estimate that's used in a model. The more data you've used, the more confident you are, and the smaller the error or the forecasting error, the more confident you are. Okay, so we're going to look into that in more detail in later lectures and actually quantify that. There's statistical measures for that. So people have difficulty with that. So I'm going to do my best to try and give you intuition for it and everything, but my main recommendation is that you read it in the textbook, okay, and make sure you've got it clear in your head. There's lots of people who don't have difficulty with these things, and you know, then they pick it up fine, and then there's people who just have difficulty, and I think they end up learning something off, but they don't really understand it. And I think you're better just to spend time so that you have an intuition for things and you can explain them, rather than just trying to learn them off. Okay. So we spoke about standard deviations. So if you use this normal distribution, so I mentioned this was the Wavre who curve fit this. To outcomes from coin flipping. Okay. Once you've got this, you can kind of measure how likely something is. Okay, so if you flipped a coin 12 times, how likely would you be to get a value that was more than one standard deviation away from the mean, away from 6? Okay. So as you move out, it's less and less likely that you would have got those values by chance. Okay. They become less and less likely. So the lower values are much less probable than the higher ones. And if you use the standard deviation as a measure, 68% of all the trials that you run should be within one standard deviation of the mean, and 95% should be within 2, and 99.7 should be within 3, okay, assuming a normal distribution. So what would happen if you flipped a set of coins, or you flipped a coin repeatedly, and you started getting lots of values out here? Okay, and this started to add up out here. What would it mean? Okay, what it would mean would be there's something wrong with the coin. It's not a fair coin. Okay, so it's not 50-50. There's something. It becomes more and more likely. If I asked you, is it a fair coin? you would kind of flip it a lot of times and you'd say, what kind of an average value do I get? Do I get 6? And you know, if you flip to 10,000 times and you're very close to 6, it's a fair coin. If you flip to 10,000 times and it's very close to 10 or 11 or whatever, you say, this isn't a fair coin. And you would have statistically proven, you'd be able to say to somebody, I'm 99.7% sure that this isn't a fair coin because, you know, I'm getting values out here. Okay. So a standard deviation, you basically you're comparing a value to its expected value, and the standard deviation tells you how far away it can get just through chance. And if it's further away, then it's not through chance. Something else is driving that. Like I said, the coin isn't fair. So when we look at relationships, like financial relationships, like between Microsoft and the market index, if you looked at the parameter that related the two of them, often what we're doing when we do statistical testing is we're saying, what if it's 0? Can you prove it's not 0? So they use this terminology of the null hypothesis. The null hypothesis is that there's no relationship and that the parameter is 0. Can you reject the null hypothesis? So it's often set up in an inverse kind of a counterintuitive way where instead of trying to prove something, you're trying to say, can you reject the opposite of it? Okay? So the opposite of the market being significant is that there's no relationship and that the coefficient in a model will be 0. And if the coefficient was 0, basically you could look at the distribution of the error from your model. Okay, the distribution of the random amount. You center it on 0, and then you look at the parameter that you got when you estimate. Okay, so let's say this is 0 here, and out here we've got 0.5, and the parameter we get in our model is 0.9. It's going to be way out here on the right, and there's 0 probability that could have happened just by chance. Okay, so you can be quite confident. You can be 99.7% confident that the value is not 0. Because if it was 0, you wouldn't get 0.9. 0.9 is too far off in terms of the amount of noise and the standard deviation of the noise for you to have measured that value just by chance. Okay, so does anybody have any questions about that? We're going to cover this again in the next lecture on confidence intervals. Okay, so we'll look at a simple linear regression next. I'm going to take a break now for about 10 minutes, and then I'll come back. If people want to get some air, I'll come back at 5 to and continue on.